Good morning, everyone, and thanks for joining us today. Welcome to the NWR Security Technology Virtual Investor Conference. On the call today, we've got Equitable Investors co-founder and investment manager, Martin Pretty. I'll pass you across in a moment to Martin, who will kick off our discussion of the Equitable Investors Dragonfly Fund. We'll have a presentation from Martin today, followed by an opportunity for Q&A. If you would like to ask a question during the call, please type it into the Q&A panel in the Zoom app. So to kick things off, I'll hand over now to Equitable Investors co-founder and investment manager, Martin Pretty. Go ahead, Martin.
Hi, Tim. Good morning, everyone. And thanks, Tim and NWR, for putting together this conference and inviting me to present today. I'm biased, given we're invested in a number of the companies, but I think it's a great lineup, so well done. Thank you. Just quickly put the disclaimer slide up. The key thing really for us here is this presentation sets out how we're looking at things for our fund and our investors. It's not advice to you, and you should conduct your own analysis and seek your own professional advice. I'll quickly go through the boring stuff. So we're a boutique investment manager. We kind of go off-road. We don't track indexes. We don't invest in large caps generally, or even the mid caps. We tend to focus in the micro cap, small cap, nano cap space. We're looking for unique opportunities. It sets it out down there. You know, we're really into constructive engagement where we don't just look at screens and buy stocks based on just the financial reports or just broker reports. We'd like to spend time with the companies and work with the companies and give them our insight where we have some, although understanding they know how to run their businesses generally better than we will as financial market people. But we think we can sometimes bring value there. It's been a rough couple of years, so we're partly pleased that FY24, the fund was probably up about 7% after 2 down years. It's been a tough time, especially in that nano cap space, and we'll show you that in a minute. Moving forward, and that's me. I started in markets at the beginning of 2000, just in time for the peak of the dot-com boom and the crash, which I think was pretty interesting to live through early in my career and not have a lot at stake at the time. I've been fortunate enough to gain experience in the Australian market from multiple perspectives, so investing, broking, reporting as a reporter, working inside listed companies and sitting on boards of listed companies. So I think that gives me some unique insight. And I guess one of the key things we always think about with these businesses, we're investing in businesses, not trading stock. We're not trading momentum. And businesses don't go in straight lines. We know there's really strong periods and periods of build where things take time to develop. And so we have a sense of patience about us as long as we see the right things happening in those businesses. Just to give you some broader context, so the last year was a terrible year for the nano caps, which is generally described as sub 50 mil market cap, at least sub 50 US million market cap, down 36%. Now, lots of the companies that are presenting today are sub 50 million market cap companies, and if you look at their performance over the last 12 months, they're kind of fallen the same as an overall average. We just crunched the numbers on that. So there is an opportunity there, and the second picture here kind of helps set that out for us. This chart with the thin blue line and the light blue mountain shows the difference in trading activity, effectively market interest in smaller stocks versus larger stocks. Now, it's not to scale because the dollar value of ASX 200 stock trading is far greater than emerging companies, but you can see clearly from here that ASX 200 stocks have sustained the value of trade and interest since pre-COVID, whereas the emerging companies peaked early 2022, and the amount of dollar trade going into that section of the ASX has declined pretty dramatically since then. We, in our monthly report for our Dragonfly Fund, have a section at the back called What's on Our Minds, where we kind of highlight a number of issues that we're thinking about. This is one of them. And we did note in the most recent monthly that there has been some recent improvement. In April 2024, we were up in volume terms, value terms on the emerging companies index by 47% year on year. That was the first month in 8 where that was the case, that we were up. The month of May was up 13%, but still on a 12-month rolling basis, the level of value of trade in these smaller stocks was down year on year and hasn't been positive since 2022. And I think for the nano caps, which you don't capture in the emerging companies index, it's probably even more stark in the decline in activity. But we don't think that lasts forever either, and that's the bad news. The good news is we've always held the view that if the marginal investor doesn't value the company fairly, ultimately strategic and financial buyers will. And there's a table here that we put together recently on recent M&A activity. Now, historical data shows a premium on an ASX stock is in a takeover situation is normally around 30-35% historically. But you can see here that 70% has been the norm of late. And that's because you've had these companies on markets smashed severely with the lack of interest and liquidity. But the performance of those companies is often still there. The boards and management teams and major shareholders are patient. And if you're going to take them out, you're going to have to pay a reasonable price. So we see that as ultimately, in the end, if the market doesn't reward you and you are actually performing and delivering, you will have this opportunity when someone does recognize it and pay value for it. Okay, going on to the security and technology space, some things we like about it. They're large addressable markets. There's some real fundamental demand drivers. It's not a pure discretionary item, and there's a real psychological element to the concept of security and the need for security. There is evidence of effectiveness. The increasing adoption of security is correlated with a decline in criminal activities, and we'll show you some of that. And there's upgrade cycles in play as well. There's the move to 4G or 5G mobile communication technology from 3G, which some of the presenters may speak about. I'm thinking Thales in particular. There's also, in the US, there's movement from old copper wires to new technologies as those copper wires have become defunct. Technology is reducing the cost and pain of adopting security solutions. Households and businesses, we think, will find it increasingly difficult to justify not deploying increasingly sophisticated security solutions that are packaged in good value, cheap offerings, and also really easy to use as the technology and the interfaces get better. We like recurring, predictable revenue streams, which are often a feature of the businesses in this space. Monthly recurring revenue models across software and the service solutions like IMB, who spoke earlier, doing the security monitoring, which there are a range of revenue models in there, but standard recurring fees are a big part of that. Churn rates are kind of minimized by the pain of switching, the inertia of having to switch, just like switching your bank or your phone bill, and the minimal impact at the lower end, lower cost solutions, the minimal impact of that cost on you. And there are parallels, we think, to the insurance industry in terms of the psychological drivers, the recurring revenue. And there's no surprise historically that brands like Chubb have been prominent in both the insurance and the security industries. Now, you don't need to read all the little bubbles in this chart. This is just to signal to you that, security encompasses a lot of things and we can't cover it all. We've just had Prophecy present, and we have Arctus presenting later on cybersecurity. We're shareholders in both those companies, but we're not really going to talk about cybersecurity today. We're talking about home, residential, commercial, health security. And I think it's really important, this concept here, which comes from an academic who is at the Harvard Kennedy School, Bruce Schneier, who's a kind of a specialist in security architecture, that security is both a feeling and a reality, and they're not the same. The reality of security is mathematical. You can calculate, what are the probabilities that you're going to be burgled, and those probabilities are declining. But it's also a feeling based on your reactions to the risks and countermeasures. And that will flow into some of these slides and data points we're about to show you. The Australian security market, this is just to give you a feel that there is a big market, even just in Australia. This comes out of IBIS World. We're talking 10 billion minimum plus, forecasting 13 billion in 28, and that's in real terms. So in nominal terms, obviously, adjust for inflation. Now, we always look to the US market as a bit of a leader here. I think they're ahead of us. They're ahead of us in penetration. Many of the major players in security have come out of the US. They're obviously a much deeper market. So the trends here you can see from these tables, I won't go through all the numbers, but clearly the market has been growing. The penetration and uptake of security products and offerings has been growing. And at the same time, crime statistics clearly show that there is a deterrence impact. Crime is declining. But what we find really interesting on the psychological side, if you see the chart on the bottom right as I look at the screen, the percentage of US adults who believe crime is growing year on year is still increasing despite the charts above it showing the reality is the opposite. So we have an interplay here of where it is effective, it's been proven effective, and the emotional pull to deploying security is still clearly there and not going away. If we turn to Australia, it's really not that different in terms of security uptake correlating with a decline in crime statistics. But we are behind in take-up, clearly a professional monitoring, and those pie charts on the left there are stolen from IMB, from Denison's presentation. I think he had it included in the one he did earlier. So we're a long way behind in that. And I think we're also behind, which I think Denison also mentioned, in the uptake of modern security technology. So I think there's real opportunities in the Australian marketplace. And again, the psychology, I haven't got a data point like I did for the US, but this survey quoted here from the Courier Mail last year that 3/4 of Queenslanders have made efforts to fortify their homes in the last 12 months. Half of them believe that youth crime is either up or at a crisis point. It tells you that even though the statistics are declining, the demand and the pull for security offerings, security solutions will still remain. And another stats that are not there, by the way, is that 8 million Australians have experienced violence since the age of 15, according to the ABS. So it is clearly front of mind. This slide is just to make clear, we're not just talking about household security. I think in the case of IMB, Denison mentioned that they may be the leading player in the consumer side, but there is a very deep commercial side. So you do not need to read the fine print on this NAPCO chart, headline retrofits and new installs. The key point is that the commercial security market in the US is 83.5 billion versus 5 billion for residential security. There are some interesting points in those comments below. Like one key one is the fact that we're in a multi-decade upgrade cycle for alarm systems. There's plenty of old systems deployed out there being upgraded for new technology, and in some cases being forced to upgrade because of things like changes to the telecommunications networks. This chart also highlights school as a community, as an opportunity. What's not on this slide, which we would also add, is hospitals, aged care, and home care are all markets for safety monitoring. I believe Graham Russell from Talius will be presenting after this, and he's probably going to focus on that opportunity. It's an important one too. Now, again, this is another slide where you don't need to see the details. It looks like spaghetti, but the key point is on the left-hand side, we've got the 3-year share price performance of a basket of ASX-listed stocks who fit this security technology theme. It's been a tough 3 years, as it has for most nano caps and micro caps. But on the other side of this, we've got the multiples of their enterprise value through their revenue. And through this period, their revenue has grown materially. The median increase for these companies between FY19 and FY23 is 67%. And if you look at FY24 guidance and analyst estimates and bank those numbers, then you're saying it's 141% growth for the median of these stocks since FY19. There's a lot of details you need to look at if you're going to assess the specifics of any of these companies that hide behind revenue growth and EV/EBITDA multiples. Obviously, acquisitions can play a part. Possibly they're not growing their revenue profitably and may be negative contributors. But we see this broadly as a signal that it's definitely worth doing the work to find out if these companies are undervalued after the 3 years of depressed share price trading. Now, we'll talk about a couple of stocks. I'm going to touch on IMB first. Denison kicked off the conference this morning. He gave a great rundown. I'm highlighting IMB first because it's the one stock in the group that really has enjoyed a re-rating over the past 12 months. There are some learnings there from the turnaround of IMB, I think, for other stocks in this space and other spaces. We first bought into IMB when Denison started the recapitalisation process back in late 2021. And there were several rounds of capital raising since to fix the balance sheet side of this company. The story that was evident in earnings back then was more modest than today. It was a 6 million EBITDA target from what they had in their business then. But they also had a vision, the board and management team, that they would be chasing major acquisitions in the sector. They've done that now, particularly with the transformational acquisition of ADT in 2023. So instead of 6 million EBITDA, we're now talking about 40 million EBITDA on a pro forma basis. The stock price has moved a bit today, but when we wrote this, the market cap was about $150 million. And the thing to remember, and I think this is a really good lesson for other companies, this market cap was only $12 million back in May 2023. There were no bids on the screen. There was no interest in this stock. But the company stuck to its knitting, was focused on delivering, chased these elephant opportunities like ADT and the small bolt-ons, and squeezed the money out of the business by right-sizing the cost structure. What we like about it, we like undiscovered businesses. So the green ticks we've got here, there was little to no mainstream research coverage, minimal institutional ownership outside the major shareholder, who's been the key backer of the recapitalisation, and tends to be a very focused, specific stock investor. They don't have a diversified portfolio. The management and board have done what they said they would do. They are very aligned with investors. Denison, effectively the CEO, managing director, was an investor who jumped the fence to run the company and get the company on the right track. Their opportunity from here is still substantial, as I think Denison set out in his presentation, to leverage its brands, its leading market position, its access to technology, which will be an enabler of growing that market, I believe, to ramp up their penetration in Australia and New Zealand. And despite the growth in market cap and share price over the past year, we still think there is a real case for it to go a lot further. If you look at the enterprise value of 225 million plus a little bit for whatever share price movement today, it's less than 6 times its EBITDA. Comparable, if you look at the ASX 200, you paid almost 11 times EBITDA for stocks. And we will, in a couple of slides, get through some other valuation metrics for security-specific stocks just to keep in mind going forward. And of course, in case it's not clear, we are owners of IMB, just to disclose that. The second stock we're going to talk about here today is Spectre. We also are owners of Spectre. Spectre is $5 million market cap. It has no debt. It's been around for a number of years. It has no research coverage again, minimal institutional ownership outside ourselves and a few other potential small interests. The management and board have been persistent. They've continued to find a way forward with minimal resources in a market where it's difficult to attract capital. They are aligned with investors to the point where the directors move to take fee payments in shares instead of cash until at least September 30 this year. They did that last year. They have grown the business. So the revenue has gone from 7.4 million in FY23 to 8.2 in FY24. They're saying 10.2 to 12 for FY 2025. And my understanding is that they haven't been aggressive at all in setting those numbers. They've been very conservative. They've demonstrated there is a need and demand for their remote monitoring solutions. So for those who don't know, what they do is they provide a monitoring technology platform that is remote. So it relies on solar power, not grid power. It relies on mobile communications, not NBN backhaul. And you may see dumbed down versions of this around construction sites. Original uses years ago would have been on remote mine sites. But Spectre has developed this and applied AI to the point where we're now seeing it in surf life-saving solutions. We're seeing it in warning systems. We're seeing it in smart cities. we're seeing people use it to detect changes in the environment and people doing unauthorized or activities in the environment that could damage them. So we see that there is a great runway and a great pathway for Spectre to take advantage of over time. And in terms of EBITDA, we're in a market where once upon a time you could get away with burning cash for many, many years to grow your top line on the basis that investors were willing to wait for the returns to come through. We're not in that kind of market anymore. Spectre has recognised that, so they're gone to as close as they can to cash flow neutral. We'll see what their next cash flow report looks like, and they're expecting EBITDA to be positive in the current year, coming FY25, with a forecast of up to 1.3 mil on that 5 mil market cap. We think, again, like IMB, maybe there's an opportunity for some M&A in there as well to help get some scale. It'll be interesting to ask Gerard about that when he presents later on in this conference. They have made a small bolt-on acquisition in the recent past. I'm not aware of them pursuing anything specific right now, but I suspect there are some interesting opportunities that may emerge over time. So we look forward to that. Just looking at some benchmarks and aspirational valuations for stocks in this sector, because it's not a deep sector in Australia. We've got on the left here some offshore VC-backed unlisted companies that I know from the company Scout Security, which presented this morning, and I actually sit on the board of that as well as being an investor. So we know these companies, Origin and NAMI, they're in our world of AI wireless sensing. Origin is reportedly valued at $136 million in that space from a capital raising it did in October. NAMI, we don't have the valuation, but they raised $10.5 million US in July 2023, and that probably gives you some indication of the scale of the valuation behind that. Then we look at a great success story in kind of personal security in this space, being Life360, and the valuations it's attracting with its growth and its scale, which most nano caps and micro caps would love to see anything half as good as that, but they've obviously got to prove their worth to get there. Then we look at the more traditional security space. There hasn't been many listings in this space other than IMB. Back 15 years ago, there was an investment vehicle listed on the ASX that owned 95% of Signature Security, which was a material player in the market. They sold that for just under 12 times EBIT. And I just point out in this slide that that wasn't a time when money was free. The cash rate was 4.75% back then. The government bond rate was 5.5%. In a roundabout way, it's interesting that brand has now just come back into IMB. They've acquired that brand. The next closest thing in the ASX is Millennium, which is more a cleaning business, but it's a cleaning and a security business with material revenue in the security sector. It was acquired in April 2024. Its multiple was much lower at 5.1 times the EBITDA figure they were using. I would argue that that's because the low margin cleaning business was the major part of that business, and it's been hard to put a high valuation on that. As the chart below shows you, which is from their independent expert report on M&A transactions they considered relevant to the space. So you've got multiples ranging from 4.2 to 10.2 there on EBITDA. Now, I mentioned earlier, I think there is some correlation between the security industry and the insurance industry. So I also think it's worth thinking about the insurance valuations when you think about this sector. If you get some scale and prove your consistency in this business and deliver on the recurring earnings, PSC Insurance, one of the major insurance brokers in Australia, just agreed to a takeover offer at 20.8 times its last 12 months EBITDA, or call it 19 times its guidance for the next year. Its competitors that are listed, AUB is trading on, its PE is probably more relevant, 19 times its EBITDA. I think is a bit confused by the fact that it owns stakes in businesses instead of 100% of the businesses. And Steadfast Group is priced on 15 times EBITDA and a PE of 22 times. Then I mentioned Chubb when I was discussing the comparison. So those two businesses, the Chubb insurance business and the Chubb security business are not owned by the same groups anymore. Chubb, the insurance business, is trading on about 11 times EBITDA. Chubb, the security business, was sold for 15 times its trailing EBITDA. So the reason why I bring these aspirational numbers up is if you're looking for a goal of what these businesses could be worth if they achieve their ambitions, these are the kind of double-digit EBITDA multiples we would be hoping for. And this is the very thin ASX security tech space that we see here on the left-hand side. Most of them don't have forecasts from brokers, so we don't have forward multiples in there. You can see the average revenue multiples 2.3, the median's 1.5. The US being a much deeper market on the right, much larger companies, much deeper. You can see you get higher EV to sales multiples, you get double-digit EV EBITDA multiples. I would highlight here also just one, alarm.com has been a kind of quasi-play halfway between technology and monitoring. They have a technology-based solution, but they distribute through dealers. They're a really interesting, fast-growing business that's been taking market share from traditional monitoring businesses in the US. And that wraps up the formal presentation. So thank you again for the opportunity to talk about this sector and these stocks. And back to you, Tim.
Excellent, thank you, Martin. That was a very good whistle-stop tour of the security tech sector, and some very actionable suggestions there about ways to play the themes. So yeah, we've got time for a couple of questions coming in. So yeah, please do pop them into the Q&A panel if you'd like to take this opportunity to chat with Martin. One question, Martin. Yeah, it's hard to sort of avoid a technology CEO presentation at the moment without a question coming in or reference being made to artificial intelligence in a very general sense. I think most investors are still just trying to grapple with even how to define it, let alone what impact it's going to have on different business models. But as an investor in several of these types of businesses that are grappling with this, how do you view the prospects of AI solutions enhancing remote monitoring of surveillance systems?
Yeah, I think AI is definitely a huge part of the opportunity set. My view of AI overall is that the companies like ChatGPT, they're going to become utilities, and there's going to be multiple replications of similar products, assuming that they can actually work out how to make the power that drives these data centers, that drive the AI machines on an efficient basis, and that the real value will be delivered by those people who actually apply the AI solutions to the real world. And security is definitely one of those spaces, and you can see that through Spectre, who are doing that to detect different specialized movement types for their customers who have specialized needs. You can see that through companies like Scout Security, again, where I'm a director of, where we're applying Wi-Fi sensing, where the AI smarts work out what it is that is moving in the space by the breakage in the Wi-Fi signal. Is that someone falling over? Is that someone who's friendly, which they can apply, say, if they know that they're connected to the mobile network, they can know if it's a phone that belongs to someone who's friendly to the household, or they've got a device that's unknown. I think AI definitely is a massive value add to the security space and will lower the cost and increase the effectiveness and play into the penetration game.
Excellent. And yeah, as you said, different ways to play it. We're going to hear from Talius later today, and being able to interpret different pressures on sensors in the aged care, home care context is could be a lifesaver. So so as I said, there's been a few actions that the attendees can take from your suggestions in terms of listed stocks. Another thing we were chatting about before we launched the session was, and this was evident through your slides, just the valuation disconnect between small listed ASX listed security tech companies, the way the valuations have really been pressured for several years versus how the ratings higher in the US in particular. This time of year, May, June, a lot of retail and also institutional investors are, they're doing some tax loss selling and on the flip side of that, is there a way that investors could play that theme for a potential upswing with things that have been oversold for unfair reasons?
Yeah, it's thank you for asking that, because it's something that we've been thinking about, and we're actually interested in whether investors would be interested in doing something on this specific tax loss selling season. It's really apparent that June is the worst month for small cap micro caps every year now. July is the best month. It's apparent the tax loss selling starts seasonally in May, goes into June. We're not traders in our main funds, so we hold on to stocks that we really like, and we take the opportunity to pick up things when they're add to our positions when they're cheap, or buy something that we didn't own when it becomes better value pre June 30. But we are kind of looking for expressions of interest on whether there is interest in actually setting up a special fund that would buy a portfolio of businesses during that May, June period and take advantage of the disconnect in pricing, where people are not trading based on fundamental value, and then capitalize it in the new financial year. So yeah, I'd like to hear from you if you are interested in that. It's an idea that was brought to us by one of our supporters. I think you would keep it small. This would not be a big fund, but you could do some interesting things with it, I think.
Excellent. Well, that's an opportunity for incoming investors, and in a broader sense, equitable investors. I take it as a fund manager, you guys are open to new investments. So for anyone interested in pursuing that further, what's the best way for people to get involved?
Yep. So first of all, we're wholesale fund managers, so you need to meet the wholesale investor qualifications to invest with us. But we're definitely welcome. New investors are welcome. We don't expect people to write out really big checks relative to their wealth, particularly because we understand that we invest in micro caps and small caps and nano caps where volatility can be great, and not everyone's ready to take a huge interest in a huge percentage of their investable wealth in that space. So we do welcome smaller investors. Our minimum investment's normally $50,000. You can contact us on the email there or the phone number there, or you can access our website. I'm really pleased to catch up with anyone. Really, always happy to talk about what I'm up to.
Excellent. Thanks, Martin. So, yeah, on behalf of NWR and Equitable, I'd really like to thank everyone for tuning in to the NWR Security Tech Conference today. We appreciate your interest in the Dragonfly Fund as well. So if you do have a question that we didn't get to just now, please reach out. Martin will be happy to discuss it further offline. And we will also make the video recording of this session available online at the NWR YouTube channel. Really looking forward to the opportunity to talk to you all again. And Martin, I might pass back to you for any closing comments.
Thank you again, Tim and NWR, for the opportunity, and thank you for putting on this conference. We're invested in a number of the companies presenting today. I've enjoyed the stories I've heard so far, and look forward to hearing the stories this afternoon as well.
Excellent. Thanks, Martin. Thanks, everyone. Chat to you later. Bye.